The Chinese economy exceeded expectations in the first quarter and is likely to accelerate further in the second quarter. Manufacturing has been a standout sector in the first half of this year, reflecting strong external demand for China's economy, which will continue to support growth in the second half. On policy, China's top leaders reiterated commitment to utilize interest rates and reserve requirement ratios to boost the real economy and alleviate funding costs. Meanwhile, on the 17th May, China's various ministries have unveiled what are currently the strongest support for the property market, covering both home buyers and developers, as well as measures to reduce the housing inventory. Early signs of a recovery in the property transaction volumes have emerged since late June in 30 major cities. For example, the 7-day rolling average transaction volumes year-on-year growth turned positive for the first time since the Chinese New Year. However, uncertainty remains for China's property market due to the still weak income expectations and negative wealth effects. Despite some initial indications of recovery, recent inflation and credit data continue to reflect an uncertain outlook for domestic demand. For example, China's consumer price index remained low at 0.3% in May. Meanwhile, both M1 and M2 growth slowing to record lows. Nevertheless, the Chinese government is choosing to push for equipment upgrades and the trade-in of the consumer goods, given the softening property markets. By stimulating consumption in bulk items like home appliances and automobiles, this initiative enhances the likelihood of China reaching its growth target without relying too much on the property market. Overall, we still believe the Chinese economy will achieve its growth target of 5% this year, even without meaningful rebound in the property market. I think for the second half of this year, the key focus on China should be China's determination to bring the economy out of deflation risk instead of whether China can achieve its growth target. The central bank currently appears to favor exchange rate stability over interest rate adjustments. Although the current low inflation rate supports the case for further interest rate cuts in China, concerns about this impact of such cuts on exchange rate stability limit the central bank's ability to adjust its interest rates. So this may delay China's timeline to roll out more monetary stimulus, running the risk of entrenched disinflation mindset, which may lead to more deleveraging activities. As such, for the second half of this year, we will closely monitor two things, including whether China will roll out more structural reform to boost domestic demand, or whether China will roll out more aggressive monetary policy to fight the deflation risk. So this will set expectation for China's growth in 2025.